Hello, welcome back, guys. Many people in the past have asked me to take a look at sorting and pretty much compile a video about it. And I think this is about time. So I'm making a video here to describe how sorting works and talk about some finer details, which I think even people who are actually well aware of how sorting works will find interesting. So I would really recommend that you stay tuned, even if you know how this works. Now, before we begin, let me, thank you for being around and also have a little bit of a request. If you like this kind of content, please like the video. That actually helps bring more people around. So thank you very much. And remember, Patreons can gain access to this PowerPoint, download it pretty much and use it at their own time, however they like. And, if you are not a Patreon, you can become one by finding a link in the description box below this video. So let's start. What is this about? What are we going to talk about? Now, of course, we're talking about investorsheaven.com or patreon.com investorsheaven in case you are interested in the material. So what is sorting? What are we talking about when we're talking about selling short? So sorting is a technique that is used to make money from assets or stocks in this case, in this video pretty much that we are making and talking about it, that go down in value. Now, typically, you know of the case when you buy a stock, you buy it at, let's say, $100, and then a month later is $200, and then you make 100% on your investment, so you make $100. Now, the opposite is referred to as buying a stock or taking a long position. So you are looking at a short position and a long position. As you can understand, a long position is basically a position that's like an investment. But when we are talking about a short position, why is it named short? It's basically named short because we are selling short, because the trader, the person who is selling stock, is selling the stock without ever owning it really. In fact, they are actually borrowing that stock and then immediately selling them to the open market. So they are short of them. They still own it to the original person. And I will go through a very, very specific example so that you understand the concept exactly on how it works, so with the diagrams and everything. So let's just take a look. We're having Bob, the short seller here, and you can see that he's a trader. It's pretty obvious with his little hat. And Joe is a long-term investor, pretty much waiting for his, investments to go right at some point. And he's getting older as he's waiting. So how does short selling work in this case? Now, Bob, the short seller, believes that Microsoft is heading lower. So today it has a price, but he thinks it's heading lower. He currently has a brokerage account, so the same brokerage where Joe is pretty much investing his money in, but he owns no stocks, so he has no long positions. Now, Joe owns 500 MSFT, this is Microsoft shares. So he believes in Microsoft for the long run, and he bought 500 shares of Microsoft. Now, Bob, since he thinks that the stock is heading lower, he actually wants to sell that stock short. But remember, he doesn't own it. So what does he do? He believes the stock price is going lower. So what he does is he borrows 100 shares from the 500 shares that Joe, the investor, pretty much is holding. So as he's borrowing them, he doesn't even get them in his account. He instantly sells them. He's selling them short. Remember, he doesn't own them. He borrows them from Joe, the investor, and he sells them short in the open market, based on the current market price, pretty much. Now, let's just say that when they sold the stock, the price of Microsoft, Microsoft stock was $100. So basically what they did is they borrowed 100 shares, they sold 100 shares, and they made $10,000, because each share was worth $100 at the time of the sale. And so now Bob actually has $10,000 in his account, but he's also 100 shares short, 100 Microsoft shares short, meaning that he owes them back to Joe, the investor, and he needs to return them at some point. Now remember, he's borrowing that, and so he's paying some interest back to Joe. As you'll see here in the fourth step, Joe is making some short margin interest, is what we call this, on the shares he lent to Bob. And this is something that a brokerage pretty much invisibly facilitates. It allows Joe, the investor, as long as Joe, the investor, wants to actually borrow their shares, their Microsoft shares here, and some other entity can actually pay a little bit of an interest over here. It really depends on the position, on what kind of stock you are actually borrowing, how much that would be. Typically, it's rather low, like 1%, 2% per year or something of that sort, but it could be higher, significantly higher in some situations. So he and the brokerage are actually making money through that, of course, because Bob the seller is actually paying a little bit of an interest here. But he's also pleased because he doesn't own the stock. he basically borrowed it so that he can actually sell it today because, again, he thinks that the price is going down. So let's examine two scenarios. In the first scenario, Microsoft, the stock that he actually sold short, is today, 6 months later, at $50. So Bob, the short seller, is actually happy because the stock is lower. So he's going to be making some money. How much money? Let's examine. Now, Bob, remember, he's short 100 shares, so he still needs to return them to Joe. What's the best time to return that to Joe now that the stock is actually lower and he can buy it at a lower price? Because remember, he sold it at $100. Now he has the chance to buy it at $50. So what he does is he buys 100 shares at $50 in the open market. That's the current price in the market, right? So he's spending what? $5,000. 100 shares multiplied by 50, $5,000. Now he returns the borrowed 100 shares to Joe and closes his short position. That's how we call it. He's closing his short. And so Bob, during this phase, actually made a total of $5,000. Remember, he sold 100 shares, made $10,000. Now he's buying them back for $5,000 since the stock price went down, and he pocketed $5,000. Now Joe is happy too, because Joe, believe it or not, he always had 500 shares in his account. Now the short position is closed. In the meantime, Joe could even have sold his 100 lent shares without a problem. And this is something that, again, the brokerage typically facilitates. That's typical, right? It doesn't always happen, but more than likely it will happen. And basically allows Joe, the investor, as long as they have inventory of his stock pretty much, to actually sell his position, even though his stocks are actually lent to Bob. And it's again an invisible thing that nobody really actually watches happen, but it happens in the background. And so both parties are kind of happy. Now, in the second scenario, you will see here that Microsoft actually really had a fantastic course and went at $300. It was $100 and now it's $300 6 months later. And Bob is actually sweating bullets because he's losing money. Why is he losing money? Because as the stock is going higher, at some point he has to actually buy the stock and return it to Joe, the investor, because he keeps losing more and more as the stock is going up and he's getting more and more scared and he potentially doesn't even have the money to cover his position. So what needs to happen here is Bob buys 100 shares at $300. And so he's spending $30,000. That's 100 shares multiplied by 300 here. So he returns the borrowed 100 shares to Joe and now closes his short position. But notice that he actually lost a total of $20,000 over here. So in the previous scenario, he made $5,000. And in this scenario, he actually lost $20,000. So he lost a lot because the stock actually pretty much tripled in value. So you can see how losses can really accumulate here and can keep on accumulating as the stock goes higher. And so if MSFT was at $500, then he would have to spend $50,000. And this is why an investor, a trader, I should say, like Bob, needs to have a margin account, an account that allows for borrowing money from the brokerage, because you cannot really tell how far his losses can go if he keeps holding his position open. Well, if you buy a stock at, let's just say you buy some 100 shares of Microsoft at $300, this is money that you have already spent. It can go to zero. I mean, if things go really wrong, but you cannot have a loss of more than 100%. You can lose your own money like 100%. But over here, with holding a short position, you can lose an unlimited amount, as you can see. Again, it really depends on how high Microsoft goes and depends on whether you have closed your position or not. Likewise, it's the same thing for Joe. Nothing has changed. He still has his 500 shares. He still could have sold 100 lent shares without a problem in most situations. So nothing really affects him apart from the fact that he's pocketing a little bit of extra here from the interest that Bob is actually paying for pretty much borrowing the shares. So Bob is actually not only paying to hold a losing position, but he needs to cover these shares again in order to be able to be covered of his position and not owe money to the brokerage pretty much. Now, how does short selling work if you want to do it? When you get a typical brokerage account, you won't be allowed to short sell. And the reason for this is that in order to short sell, you need to, it's a dangerous game. So you need to have a lot of money. And the thing is, if things can go really wrong, you may not have enough money to cover your losses. And this is why you require a margin account, which allows a typical trader or investor in some situations to actually borrow money from the brokerage and pretty much leverage their positions. And a short sell is a leveraged position, meaning you don't know how far you can lose. you know how much you can gain, and that will be 100%, but you don't know how much you can lose. And this is why you need to borrow money in case things go wrong, and this is why you need a margin account. While if you buy a stock, you can just lose the amount that you bought. It's your money, you can lose it, no big deal. Now, because again it can cause unlimited losses to the short seller, is something that we examined earlier, you do require this margin account. It's safety for the brokerage pretty much. Okay, so what about risks? Again, so there is an unlimited potential loss. You can only lose 100% of a stock that you bought long. Remember, we call it bought long. But you can lose an unlimited amount of money in a short position. So if you sell short at $10 and it goes to $1,000, imagine the loss. And if it keeps climbing to $2,000, imagine the loss. You may be thinking, how likely is that to happen? But it has happened a lot. You may examine a situation with Tesla, for example, and an investor called Jim Chanos, or Hanos, I'm not sure how it's pronounced, actually, I don't remember. But he actually lost a lot of money because the stock price actually headed higher. Now, a steep increase in price can lead to a margin call where the trader has to add money to their account. So remember, in the case of Bob, he actually gained $10,000, but then eventually in the second scenario he had to pay back $30,000, and he didn't have this money in his account. This would lead to a margin call. So the brokerage would ask Bob to actually deposit an amount of money to pretty much cover his position over there, or pretty much help the brokerage make sure that actually Bob can cover his potential losses. So he will need to keep feeding his account as long as it goes down in value. And this is called a margin call, a call to actually deposit more money. So what is naked short selling? You may have heard of this term. Now, when you are selling a short stock, you typically borrow it from somebody. But there is a case where you can actually potentially sell a short stock without having borrowed it first. And it's considered an illegal practice currently. And the thing is, over here, it is basically thought to undermine the free market, because you are trading with things that basically do not even exist, and you can undermine the underlying asset, basically influence it to its downside in some situations. Lehman Brothers, for example, was a case where it was thought that naked short selling has played a little bit of a role there. But it is considered an illegal practice, and it's useful to know about it. The practice of selling short stock that you haven't borrowed at all is called naked. What is short interest now? Now, when we're talking about short interest, we want to identify how many people have actually sold a stock short. And so basically what we do is we examine the number of shares that have been sold short in the open market without having been covered. So basically open short positions. What is the amount of shares that are opened as a short position? And it is expressed as a percentage of the stock float, which is the amount of shares that can be traded pretty much daily. Here's an example. The float of a stock is 1,000 shares. Pretty much, again, the float is the amount of shares that can be traded. And 100 shares are actively held short. If you do the division, this is a 10% short interest. So basically 10% of the float is actually held short, actively held short. Typically a short interest of 10% and above, typically that is, indicates that it becomes tougher, a little bit tougher to find stock to buy back and cover a short position. And also it indicates that potentially the stock, the underlying company, is not really doing that well. It's sort of like a bearish sign for the company in most situations. The higher the short interest is, the more possible it becomes for a potential stock squeeze though. And we'll take a look at it at a little bit of a later slide, but remember that the short squeeze. Now, before we cover the short squeeze, let's also examine the short interest ratio, also called the days to cover ratio. Now, with this ratio, we want to identify how many days on average it would take a short seller to cover their position, if they have a short position. And so it's very simple to discover that. We basically see the amount of shares held short, and then we divide it by the average daily volume that is being traded. So basically, there is always an average volume that is being traded per stock, pretty much. And so if 100 shares of the company are held short, and there is an average daily volume trade of 50 shares a day, this would mean that it would take about 2 days to cover. That is all short positions. If all short positions had to be covered pretty much starting from today, how many days it would take based on the amount of shares that are traded is what we are actually trying to discover here. So 2 days in this case. And so now, what is a short squeeze? Now, typically, as I mentioned earlier, a high short interest and the short interest ratio are bearish indicators because nobody's going to be shorting the stock if the company is doing very, very well. It's very unlikely. But when things get exceedingly high, when we get like super high like short interest ratios and a high short interest, it can become a little bit difficult for short sellers to find shares in the open market to cover their short position. And so if something changes, if some positive news comes in, for example, there will be less supply, there will be fewer stock to actually buy in the open market and more demand from short sellers because, they're losing money, the stock is going higher. And so they need to cover their positions, they need to buy back shares and pretty much send them back to the party where they borrowed it from. And so this becomes harder and harder, and it squeezes the short sellers, is what we're calling that. It makes it harder for them to find stock in the open market to buy, and the price is getting higher. And when this happens, you can have some insane increases in stock price. And this is exactly what happened with GameStop. In case you didn't know, now you know exactly what happened with GameStop. It's there was sort of like an organized plan for the stock to go higher, and then as it went higher, then it went even more high and high and high and high because people were trying to cover their positions and caused a massive short squeeze there. Okay, what's the safer way to bet on the downside? So let's just say that you would still want to bet on the downside, but you understand the risks of shorting. So you don't really want to short, but you think that something is going down in price, an asset. Can you still short it without having all these risks? And the answer is yes. Instead of short selling, you can actually buy and hold, like as a long holder, the inverse of an index and bet on its downside, while pretty much holding this ETF or derivative on a long position. You can still make money as the underlying asset goes down, but you can lose at most 100% because you basically just bought. You bought an asset. It's not like you actually hold an asset short. And you may be wondering how this works. It's basically a derivative. So it happens through derivatives that they are creating sort of like an ETF, which tracks the performance of, let's just say, gold, and actually does the opposite. It's basically the exact inverse of what gold would be doing. Okay, so DGZ, for example, is an inverse ETF and is 1x leveraged, so it's basically not really leveraged here against the performance of gold. This means that if gold goes down 10% in a day, this ETF will gain 10% in value because remember it's the inverse. So we're actually betting on the price of gold going down. So when the price of gold goes down, our ETF, our derivative here, will gain 10% in value. And if gold goes up 10%, then we will lose 10% in value. Now, there is a little bit of a risk here. There is a 3x leveraged inverse ETF or a 2x leveraged inverse ETF. For instance, Nugget. Nugget actually used to be a 3x leveraged. I remember it was 3x when I was actually trading it. Right now, it looks like they have switched to a 2x leverage because of the risks, I suppose, against the performance of gold. And Nugget is actually the ETF that is actually positive for gold. Dust is I think I made a mistake here. Dust is actually the inverse one. So Nugget is the one that is positive for gold. So it's basically tracking the performance of gold as a 2x leveraged ETF. And Dust would be the opposite, which is tracking the 2x leveraged loss, pretty much. So if gold loses money, then Dust would gain. And if gold pretty much gains money, if gold gets like 10%, then Nugget will go up 20%. If gold actually gains 10%, the Dust goes down 20%. So as you'll see here, if you are owning Dust again and gold goes down 10% in a day, the ETF will gain 20% in value because it is the inverse. And if gold goes up 10% in a day, Nugget, which again is the inverse, will lose 20% in value. So again, Dust is the positive one, Nugget is the negative one, pretty much, the inverse one. So I made a little bit of a mistake in this slide, so bear that in mind. Now, there is a danger here, a very, very important danger with leveraged instruments. Some people don't understand their use and they like to keep them for a long term. They think, okay, if I can make 1x, why not make 2x or 3x? It sounds nice, right? I can make more and faster. Why not hold this? But it's very, very problematic because if you hold this for a long time, you will more than likely lose money and you can actually even lose the vast majority of your position. Because think about it, if you hold $1,000 in nugget, which is the 2x bearish one, as I mentioned earlier, and gold goes up 10% the next day, you will lose 20%. This is a 2x leverage, remember, of your investment. So thus, you lose 20%, you are left with $800 over here. Now gold, then the second day goes down 10%, which is good for you, and you make 20% on $800, which is a total of $960. So notice this, first day gold goes up 10%, then next day goes down 10%, yet you still lost money, you lost $40. This is called the decay effect, and it comes from this fact here. The fact that when you lose 50% on an investment, you need to make back 100% in order to make your money back. Remember that is very, very important with investing. If you lose 50% of $10,000 and you go back down to $5,000, you would need to gain 100% on this $5,000 in order to pretty much be on the same amount that you had before, to break even pretty much. So remember that this is called the decay effect in these leveraged instruments here, and this is why it's very, very dangerous to invest in these kinds of leveraged instruments. They are meant to be played on the daily chart. And so only short sell on the daily chart is the important thing that we need to remember here. Holding short positions overnight is very, very dangerous. And even if you think you know what you are doing, you can really, really shoot your feet pretty much. And higher float stocks, meaning that they are heavier, so more stocks are actually traded in the open market. They are more secure. They're a little bit more secure when you hold them. When you hold them overnight, for example, or for many months even, than penny or low float stocks. Because remember, when you have a lower float, it's much easier to get a squeeze, and this would mean that it's much more difficult for you to actually lose a lot of money when you are trading, the apples or companies that have very, very high floats, pretty much a lot of stock. They're not going to be moving that fast, is the thing. Now, selling short on the daily is not a bad idea if you're a trader, as long as you have tight stop losses, and your trades are not really taken into pre-market or after market hours, is another important thing to remember here. Now, that's what I wanted to talk about in this video. Obviously, there can potentially be a lot of things to talk about when we're talking about short selling, but I would love to hear your questions and what you wanted to potentially comment below about this video, about short selling, or anything else that you wanted to say about investing. I guess the negative aspect of investing, like investing in the fact that stocks could go down in value, or other instruments as well. So again, I have to thank you for watching the video. Please again remember to like and subscribe if you're not a subscriber already. And again, if you're a Patreon, you can find this PDF, this PowerPoint on our Patreon account, on your Patreon account. You can just download it and peruse it as at your own will whenever you want it. But thank you for watching again, and I'll see you soon. Bye-bye.